So welcome back, guys. So we are back here for one more interesting session on corporate valuation. So we have around how many participants? I guess around 150 participants have joined in from different Zoom calls. So just wait a second, let all the Zoom calls get connected for different WhatsApp groups, right? So just a small notification. I am also starting with a new investment banking batch, right? So that would be the batch number 45, right? So you guys can just talk to your friends or like investment banking aspirants who want to start up their career into corporate valuation. So they can have the registration for the curriculum. And also, like before we start with this curriculum, like one request from my side is like before we go further, like with the subsequent sessions of like these batches from batch number 1 to 35, I guess, are combined here into the Zoom call. So my one request, like it's a joining hand request to all the participants. Around 145 participants are here in the Zoom call. So it's a request to all those participants and for all those as well who would be watching this session in a recorded way after the session is completed. Like whatever I'm posting on LinkedIn, right? I'm repeating this point. So whatever I'm posting on LinkedIn, please go through all my posts and videos, right? That content, it might be like 20-30% different, or it might be somewhat in a much more complex manner, like regarding the concepts of valuations or the inputs of valuations that we are using with the risk-free rate calculation, the different methods to calculate the risk-free rate, the different methods to calculate the growth, like in the DC evaluation, the different methods to calculate the cost of capital, the different methods to calculate the risk premium, the different methods to calculate your terminal value, ROE, ROCE analysis, right? Though mostly like all these things have been covered in my modules as well. But still, I try to upload some complex advanced content which might not be covered in the modules or might be a part of the subsequent sessions in my modules. So it's a folding hand request. Just watch all those my LinkedIn posts and videos. You might get some additional insights. And obviously, like if you're not getting to understand those points, which I'm posting on LinkedIn, like get back to me, like ask me questions on my mail ID through Instagram platforms, through LinkedIn, through WhatsApp, right? I'll be like more than happy to answer your concerns. But I'm telling you, like there might be some advanced complex concepts which might not be covered in the modules or the live sessions or might be a part of the subsequent live sessions. So not to wait for that. It might happen that you might be having your corporate interviews for equity research or financial modeling tomorrow, right? So in that case, you cannot wait for my session to be like for next week or next month, correct? So have a go through like about these sessions, about the post on LinkedIn and get back to me for your concerns. And do not wait that I would be keeping a live session for your doubts, right? Of course, I would be keeping that, but that like it might not match like with the timing of the process of interview, correct? So make a note of that and ask me your concerns. Okay. So getting back to the session for today, as tagged as corporate valuation. So before we talk about like some of the talking trends or like some of the most important like metrics in the corporate valuation, apart from the metrics or like apart from the theories or concerns or the kinds of descriptions like which I've given in the previous session, like some of the things you people need to know like about the economy, right? And these are some macroeconomic indicators, correct? So ideally what happens, like when we talk about the macroeconomy or the macroeconomic trends, in that way, so like before I start, just let me know like if I'm audible to all, if I'm audible to all clearly, just a yes or no in the chat box. I should be ideally, but like just a confirmation from the guys. And please don't sleep in the sessions. I would just like request all the participants to write a yes in the chat box. 20, 30, yeah, like a huge like response that I'm receiving. I'm like clearly audible and visible as well. Yeah. So see, like whenever we're talking about like the macroeconomic conditions or the macro trends in the market, like whether the economy is doing good or whether the economy can do good in future, like we try to analyze a few of the things, right? So a few of the things that we're trying to analyze is like people like usually talk about the gross domestic product or GDP, right? They talk about the purchasers managers index, PMI, right? And they talk about the IIP, the index of industrial production, right? These three indicators people are extensively using, and even like we are also, I mean to say, know about it. right? So I'll just write these three indicators. So these three indicators, I'm saying people are stressing upon the importance of these indicators, correct? People are stressing upon the importance of these indicators, but they are ignoring the other indicators as well. What? They are ignoring the other indicators as well. And what are those other kind of indicators? I will just tell you. Just give me a second, right? So see, like whenever people are talking about the macroeconomic trends or the macroeconomic conditions, correct? The one thing that people are ignoring about is, yeah, they talk about GDP, right? We know that what is gross domestic product, like it is the market value of all the goods and services produced in the country, right? So it's the summation of your government expenditure, your private consumption, your household expenditure, and your net exports, right? Export minus imports, correct? Then people talk about the purchasers managers index PMI, right? So that basically shows the sentiment of the people like who are purchasing that raw materials or that ingredients for their business, right? To make the final output. Correct. Like if the people are buying more of the raw materials and there is more production activities, so that kind of indicates that economy of that particular country or maybe that global economy is on a rising parallels. And same with GDP. Higher the GDP projections of the country, it is good for the economy. And we have seen that the GDP projections of India has been far higher for the next quarter, 6%, 6.4% as compared to the other developed economies or emerging economies. Like US has an expectation of like 1.4% max to max, right? But India is having an expectation of around 6 to 6.4%. So again, higher the GDP projection growth for the company or the country, sorry, like it is good for that particular country or economy. And same for the PMI, the Purchasers Managers Index. It is basically showing you how confident the managers are, how confident the people in the company are to buy the inputs, to buy the raw materials, to facilitate the manufacturing activities or the production activities to produce that final output. And the third people tend to talk about is our IIP, Index of Industrial Production. Again, almost same as the PMI. Your PMI talks about from the manager's point of view, from the raw materials point of view, that how interested are the people of the company or the management of the company in procuring the raw material to make the final product. And your index of industrial production, it basically tells you that how much production activities are taking place in a particular country or economy. Ideally, these PMI numbers or IIP numbers must be more than 50 because that indicates that the numbers are really good and people are procuring those raw materials or purchasing those raw materials and making the final good. And in India, these numbers are plus 50 only. Correct. So ultimately, like people talk about GDP, PMI, IIP. They also talk about the interest rates, right? They also talk about inflation. Okay, and I have been talking about the concept of inflation and interest rates like in the previous sessions, right? Having the current repo rate as 6.5% per se, or having the kind of inflation, the amount of inflation is like 4.25, right? The latest data, like as per May, the rate of inflation in India is 4.25%, correct? So again, the repo rate is beating the kind of inflation rate or the amount of inflation rate in India, correct? Because like it's around 6.5% the repo rate your like inflation is like 4.25%, correct? So like that's like still a question, like whether the Fed would increase the interest rates like by one or two stages, or like whether the RBI would increase the rate of interest by like some percentage. But like the one thing we know that almost the amount of interest rates have come to a pause, right? But we are like ideally calling it as a hawkish pause. Ideally, when the interest rates are expected to come down, it's a dovish stand, right? When the interest rates are expected to go up, we ideally call it as a hawkish stand, correct? So, like in this phase, though, expectation is in the long run, or maybe like after this year, the interest rates might come down. But still, the US Fed as well as the Reserve Bank of India have indicated that they might still increase the interest rate one or twice in this particular year, max to max. And that is why I'm terming it as a hawkish pause, because the pause is there that gives us a relaxation that the interest rates might come down. But before that interest rate might come down, there is always a possibility that the interest rates might go up. Correct? By how much it will go up, that's still a question. But again, we know that in the long term, maybe after this year, after like 1.5 years to 2 years max, the interest rates might come down. Correct. So people have been talking about the gross domestic product GDP, the purchasers managers index PMI, the index of industrial production, IIP, inflation, interest rate. But we also need to understand about some of the metrics which are also related to the particular companies in an economy as well in an overall basis, right? So like, for example, we need to understand your inventory to sales metric, right? Inventory to sales metric we need to understand for the companies, or be it for India per se, or be it for any other kind of economy that we're taking into consideration for the purpose of our analysis, right? So what do we mean by this metric, inventory to sales? Inventory to sales is nothing but how much sales we are able to make out of the amount of inventory or goods that we have, right? So ultimately, this number should be as low as possible. And why this number should be as low as possible? Because we ultimately want the denominator of this ratio should be high as possible. Why? Because we want the sales should be high as possible. The capital of the company should not be blocked, or the working capital of the company should not be blocked in the form of the inventory. The company should have inventory, but that inventory should be sold off as fast as possible. The company should not have any amount of holding inventory. I mean to say that there should not be a situation when the inventory of the company is not getting sold off. Because if the company is procuring that inventory and that inventory is not getting sold off, it's a bad indicator for that particular company or maybe for that overall economy in general. So I'll just give you a simple example. Like, for example, I run a grocery store, correct? So like, for example, if I am ordering like 50 packets of biscuits, right? My major business is like biscuits and namkeens, for example. So I am ordering that 50 packets of biscuits and 200 packets of namkeens, right? And my target is to sell that 50 packets of biscuits and 200 packets of namkeen in one particular month. But at the end of the month, I purchased all these things as of 1st of January. But as of 31st of January, I'm still left with 40 packets of biscuits out of the 50 packets I purchased, and 100 packets of namkeens out of the 200 packets of namkeens that I purchased. Ultimately, it's not a good signal for my business because I was having the expectation, maybe from the past trends, that my monthly demand of biscuits is 50 to 60 packets per month, and demand for namkeens is like 200 to 300 packets of namkeen. But ultimately, my sales have been less. So as a result, my working capital is blocked. Inventories are not getting sold, and I'm not realizing cash out of that unsold inventory. So ultimately, I want that whatever amount of inventory I have purchased, I must be able to sell it off. And that is why my inventory to sales ratio must be as low as possible, because I ultimately want my sales to be higher and my working capital should not be blocked in terms of inventory. Correct? So that is one ratio. The second ratio, like, you need to take into consideration is your credit growth by GDP. Ideally, in the previous years, like when the rate of interest was too low, this ratio was around 70%, like 80% in India. The global average is around 60 to 62%, correct? But currently, since the interest rates have risen, India has come to a number of like 49 to 54% ke beech ka number, correct? So what is basically like this ratio is telling you how much credit demand is there in a particular economy or country as compared to GDP. And ultimately, we want this ratio should be as high as possible because we want the GDP should grow ultimately, but the credit growth or the credit demand in the economy should also grow, because ultimately the banks or the financial institutions which are running the country directly or indirectly, they want to earn money, and they earn money in terms of a net interest spread. That is by giving you a lower interest on your deposit and take a higher interest from the loans which they have given to you. Because if in an economy the credit demand is not good, that stimulus is not good, ultimately that economy cannot do good. Because ultimately we need to stimulate demand, as happened in case of Japan also. The average age population of Japan is like 55 to 60 years. And people who are in the age group of 55 to 60 years, they do not demand much of the goods because a huge expenditure for them is upon their is upon their health, hospital bills, or they just have to save money and they just have to put in the lifetime expenditure, like just the usual expenses. But that average age population of like 55 to 60 years, it won't be taking loans because the earning source is not there and they won't be able to pay back loans. Or a majority of the people won't be spending upon the luxury items. So as a result, on account of the average age of Japan, the banks or the central banks of Japan or the Bank of Japan had to make the interest rates negative so that the people take loans, right? So the Bank of Japan were paying people to take loans ki like हम आपको पैसे दे रहे हैं आप लोन ले लो, correct? Like because the demand was too less because of the average age of the population there, right? So ultimately the credit growth in the economy should be stimulated. So when the interest rates are low, the credit growth by GDP ratio might be high. And when the interest rates are too high, like this ratio like might come down. But ideally, this ratio should be more than 40-50% ideally. And we want this ratio should be as high as possible because we want the demand in an economy. And that demand should not come at the cost of GDP as well. It should not happen that the GDP of the country has become too low, has gone to negative, or like has become 1% or like 0.4%, as happened in US. But the credit demand is too high, like because in countries like US, we see people are dependent upon the credit cards only. More than 80% of the population is dependent upon the credit cards and they take huge loans and they service all the requirements to loans and the credit cards. But that ratio is too less in India, correct? So ultimately that happened at the cost of GDP in US. But as per se, like my hands on the word, these things are not happening in India. But as a result, but like per se, like if we say in general, the credit demand should be as high as possible, or this ratio should be as high as possible. People should depend upon the credit, but they should not take advantage of the undue credit being given to them at the cost of GDP. They should be able to pay back their loans and they should never be bad loans. Correct. I'll just, any queries till this point of time? I'll just take a fresh whiteboard. Any queries till this point of time? If not, I'll just come up with one more metric. And these are some macroeconomic metrics, like which can be used for countries as well and for companies as well. So apart from the valuation metrics of PBB, P ratio, PB ratio, your like liquidity metrics, your like debt structure metrics, capital structure metrics, the turnover metrics, like these ratios are also very important, which take into consideration your macroeconomic conditions and combine them with the company metrics to make you understand how well the company is performing or overall how well the economy is performing. Then you have something as price to income ratio. So ultimately, this ratio should be as low as possible. Why? Because ultimately we want the income of the people should rise or the income of the company should rise as compared to the price that they're paying to purchase that raw material. Or when we're talking about individuals or people of the economy, their income should be high as compared to the price they are paying to buy a particular good or commodity, right? Because ultimately, like when this ratio will be low, when the income is high, mathematically, when your denominator is high and price for the commodities that you are paying is low. So ultimately, we want this price to income ratio should be as low as possible. Ideally, we prefer a ratio of less than 60% or less than 50%. Correct. After that, like GDP we talked about, right? So see, like one thing you need to understand earlier, like in the era of like 2011 to 12, right? So when the kind of manufacturing activities or the production activities were being taking place in India, right? So one unit of manufacturing, for example, like one unit of manufacturing, it used to produce upon 13 to 14% of gross value added. The gross value added is nothing but it is almost same as the GDP, right? So like it is nothing but the value of the output, right, which you are producing in comparison to the amount of raw materials that you have purchased and your intermediary goods. Correct. So basically, the final output that you have produced in the economy, the market value of that output that you have produced in the economy, it is your GVA. So, like what used to happen around 2013 to 14 or like 2011 to 12, one unit of manufacturing, right? Just make a note of this number. One unit of manufacturing, it used to produce around 13 to 14% GVA or the gross value added. But in this phase of 2020, 21, 22, or 23 per se, one unit of manufacturing is producing around 28% to 30% GVA. If you see the current scenario of 2022, one unit of manufacturing is producing around 28 to 30% GVA, gross value added, and it is a very good indicator for the company or the enterprise, or basically for the whole economy in general. And here I'm talking about India, correct? So this GVA has risen, and it is a very good indicator. And apart from that, people also talk about the capacity utilization. So what is the capacity utilization ratio means? For example, if I have 100 machines in my enterprise, right? If I am running a company and my factory has 100 machines, right? So at least maximum amount of machinery must be used, and that is nothing but your capacity utilization. If all that plant, machinery, equipments are there into my enterprise or into my factory, almost everything must be used. And if 20 or 30% is not getting used, it means that all those machineries, equipments, and plants are waste. I wasted my investment into that, or I'm not having a positive net present value from those investments. I've talked about the concept of NPV in my modules as well, because it is nothing but the difference between the amount that you are getting from your investment minus the amount that you have made to buy that investment or put that amount into that investment. For example, if I have spent 100 rupees to purchase that machinery, so my return from that machinery should be at least 101 rupees to get that 1% ka return, right? As high as possible. By obviously the machine won't be giving me returns directly. It would be like manufacturing goods and services, and out of the revenue which I make from selling off that goods and services, like would be my indirect revenue or gain from purchasing that machinery. If I'm making nothing out of that, or if I'm losing that revenue like from that machinery, it's a negative NPV for me. So, for example, if out of that 100 machines, I'm not using 20 machines, it's a negative or a zero net present value from me, because I'm not able to make out some return or get the returns from that machinery. So, ideally, I should be able to use all the machineries out of that 100 machineries. A good number is at least 70%. Like you should have at least 70% of the capacity use in your factory or enterprise. That capacity utilization should be at least 70%. If you have 100 machines in your factory, at least 70 machinery should be used. The number should not be less than 70. And the current number in India is more than 70%, around 72 to like 73% capacity utilization is there. So make a note of these numbers and make a note of all these metrics which I told you. The session is getting recorded. Try to revise these sessions, try to understand these sessions, and try to answer your concerns and queries. Right? So basically, in this part, I've tried to talk about the gross domestic product or GDP. I've talked about the PMI, the Purchasers Managers Index. I've talked about the Index of Industrial Production, IIP, where PMI and IIP must be more than 50%. I've talked about our inventory to sales number. It should be as low as possible. Of course, GDP should be as high as possible. I've talked about the credit growth to GDP ratio. It must be as high as possible, but not at the cost of GDP. Price to income ratio as low as possible. Approximately should be at least less than 60% or 60% per se. I've talked about the gross value added around the time of 2011 to 12. Like one unit of manufacturing used to have around 13 to 14% GVA. But as in the present scenario from 2020 to 22, one unit of manufacturing is giving around 28% to 30% GVA. I've talked about the capacity utilization ratio, at least 70%. These things are macroeconomic trends or conditions that you should know about, right? So like someone just asked me, can you please explain index of industrial production? So see, like whenever you are talking about index of industrial production, correct? How many or how much amount of production is being done in an economy? Because the higher the amount of production, the higher the amount of goods and services are getting produced, higher would be GDP, correct? It's a question from Shiv, my friend. Yeah, Shiv. So higher the amount of goods and services that we are producing in the economy, higher would be the amount of GDP, correct? Because GDP is nothing but the market value of the goods and services, correct? So if your index of industrial production, IIP, is higher, It is basically telling us that the manufacturing activities or the production activities in one particular economy are high, right? And that is a good signal. Like more goods are getting produced, more iPhones are getting produced, more EV batteries are getting produced, more steel activities are getting produced, like more metals are getting produced, more oil is getting extracted, more garments are getting produced, more pulses, more cotton, more wheat, more steel, aluminium, XYZ. So all those activities are getting produced, correct? So that will stimulate ultimately your GDP as well. Because GDP is nothing but the market value of the goods and services produced in the economy, right? So that is your index of industrial production. It should ideally be more than 50%. Understood? Any more questions? See, like there is one thing called as your debt to GDP. How much debt a country has as compared to GDP of the country, correct? Everyone wants this ratio should be as low as possible because ultimately the government or the public enterprises should take as low or as much as low amount of debt because if the debt is high, if the debt of a country is high, it poses risk for that particular country or economy, correct? Because it reduces the credit rating of that particular country or economy as well. It increases the credit risk of that economy as well. If your debt to GDP ratio, here I'm talking about your debt to GDP ratio, it should be as low as possible. Debt should not be risen at the cost of the gross domestic product. In India, the range is this ratio is around 80 to 84%. US has around 150, 160%. High risk economy, right? But the one thing that you need to understand, or one thing that is quite not explanatory, I would say, these rating agencies, right? The global rating agencies, your S&P, right? Your Fitch, they all rated India as B positive. They not even gave the country as A minus, AA plus, or triple A. They gave the country as B rating, right? Which is a good rating, but not a prime rating or not an investment grade rating, I would say, right? It's a good rating. But US, who is having a debt to GDP ratio of 150%, 160%, is getting a rating of A plus, right? I'll get back to the question of you, Shiv. So the thing is, if the countries, because these Fitch, S&P, these are the rating agencies of US. US having a more risky economy, having a debt to GDP of like 150% or like 160% is having a rating of A plus. Even the debt ceiling was reached, right? The US reached that debt ceiling as well, correct? And the debt ceiling had to be risen. Still, the country is getting a rating of A plus. And India, which has a debt to GDP ratio of around 80 to 84%, जहाँ पे like debt ceiling का भी issue नहीं है, the country is getting a rating of what? B plus or like B minus. Do you think the rating agencies are fair in that way? I personally think no. कि like US की एजेंसी है तो like US इकोनॉमी को अच्छा रेट कर है. India like it does not belong to US, so like they have rated it to like B positive or like B minus. Because ultimately US is the reserve currency. I've uploaded the lecture on my modules as well. US dollar is the strongest currency, and they have to make people invest into that to make that currency strong. And as a result, now the countries are coming together to have a different currency as the global currency. So that things will take time, but these things like you have to be like very wary about. I would say that S&P or like Fitch giving a good rating to US, having a higher debt to GDP ratio, having a low credit rating, and these stuff, but India getting a bad thing. Correct. And there is something as your corporate debt to GDP ratio. One thing is your debt to GDP ratio, like which takes into consideration all those things, XYZ things, right? And the other thing you have is what? The other thing you have is a corporate debt to GDP ratio. So when we're talking about the corporate debt to GDP ratio, it takes into consideration the debt taken by the corporate only, right? But the debt to GDP ratio, it takes into consideration the debt taken by the public enterprises, private enterprises, government in general, correct? India mein the corporate debt to GDP ratio is around 40-50%, right? And why did it like reduce? It reduced from 60 to like 70%. Why? Because the interest rates came down, right? But now since the amount of interest rates have risen, again the ratio came from like 40% to like 59 to 60%. Correct. Again, that ratio is much higher in US, right? So these things you have to take into consideration. Adani Enterprises. Why did the interest cost of Adani or the debt to equity ratio or the debt to capital ratio of Adani came down in like 2020, like 21? Because the interest rates were too low. And again, the debt to equity ratio, it started to rise once again in 2020 or like 23 because the interest cost became too high. So people say कि like Adani is doing good, the debt to equity ratio has come down. Bhai, you also have to take into consideration the interest rates came down. And as a result, the interest cost became too low. Every company like who has taken hundreds of crores of debt will do good because the interest rates have come down and there are those like restructuring and moratorium schemes available. But when all these schemes get shut and the interest rates are coming up, the interest cost of these companies also become high. And as a result, their debt to equity ratio or the interest coverage ratio will also become low, I would say, because interest coverage ratio is nothing but you are like EBIT by interest. And when will this ratio become low? When the interest cost will rise and your earnings before interest and tax will come down, right? Interest coverage ratio, it comes lower and your debt to equity ratio, it rises, right? So all these things we have to take into consideration, right? So coming back to the question, like someone has asked me that what's the difference between your index of industrial production and GDP? Index of industrial production is related to GDP, but like both of them are different. Index of industrial production, it is just telling you how much goods and services are getting produced. It is at the cost value and not the market value, right? Because some kind of margin these companies charge when they're producing these goods outside. Index of when they are like selling these goods outside, right? If I have purchased something for like 10 rupees, right? So by all that manufacturing cost and to make that good, the cost is 10 rupees. I won't be selling that good in the market for 10 rupees. I'll be selling it at 12 rupees, 15 rupees, or 20 rupees, depending upon the nature of my business. If it's a luxury business, I'll be able to command like more premium. If it's a non-luxury business, I might not be able to command more premium because my focus is to work upon the volume and not the price. So our index of industrial production is just telling you the cost of production. Like कितनी like production activities हो रही हैं in a country. It's not telling you the market value or the selling price of those goods and services. But GDP is not the cost price of the market value of the goods and services. It's the market value of the price of the goods and services. Markup karke and profit add karke at what price these goods and services are getting sold in the economy. But your index of industrial production is taking into consideration only the cost of production. GDP, it takes into consideration your private consumption, right? Your household consumption, your government expenditure, your net exports, that is export minus imports. But IIP is not taking that into consideration. It is just taking into consideration the level of the production activities, how much amount of production is being taken into consideration by the whole country. But GDP is taking into consideration your private consumption, how much goods I am buying, right? Your household consumption, how much goods the people are buying, your government expenditure, how much government is spending upon roads, highways, right? How much goods we are exporting outside and how much goods we are buying from outside, imports. But net export should be a positive number. And we have seen currently also your current account deficit. Your current account deficit as a percentage of GDP has fallen from 3% to 0.2%. People 3% to like minus around like 3% to like minus 0.2% because people were expecting the current account deficit, right? It was a current account deficit of minus 3%. It came down to minus 0.2%. It's a very good signal for the country. People were expecting it to be 0.2% positive, right? But still having a number from minus 3% to minus 0.2%, it's a positive number. And why this number like did not become positive? Because in the starting part of the year, the oil prices were too high, right? But now the prices have come down, and the next number we are still expecting to be like positive. It's a very good achievement for the country, right? Any more questions? The current account deficit has been ideally around like 3% of GDP, and now it's like 0.2%, right? So it's a deficit I'm talking about, right? And in the future quarters, it's expected to be a surplus current account. We always have been talking about the fiscal deficit, your like current account deficit. But in the future quarters, fiscal deficit, I don't know, but current account surplus would be there instead of deficit if exports are good and all these things are good. The terminal value carries a major weightage in driving the firm's value, but that's in future. How would analysts reduce its effect to arrive at the accurate firm value? See, that is the major thing. Your terminal value will be having a maximum value in the valuation. If the current value is having more value than the terminal value in the valuation, or if the valuation of the company is getting a higher number on the basis of the present value and not the terminal value, it means something is wrong. It means something is wrong. The cash flows are not so good for the company. The cash flows are maybe not so, the quantum or the volume of the cash flows maybe like is not so good, like for that enterprise. The cash flow like must be good, right? Because ultimately, like we're calculating these numbers on the basis of cash flows only, right? All the value or the major value for the company should be derived from the terminal value. If all the value is being derived from the present value and not the terminal value, it is something wrong. It is indicating that the business is diminishing in future, because terminal value, it takes an assumption that the business will have a foreseeable future. It will go on at a constant rate. Maybe the higher rate can be there, of course, but at least a constant market rate, either same as the GDP rate or same as the risk-free rate ki growth pay, the company will increase. But if that is not happening, if the present value is higher than the terminal value, it indicates that the business might be going down. The business might not be going at least at a constant rate or at a GDP rate or at least at a risk-free rate of the economy. So that is bad for that company, right? So if you are trying to make a number and trying to like getting into a number in which you are trying to exclude the value of the terminal value in the calculation, you are going wrong. You have to give weightage to the terminal value, because that will make sure the company will not go down in future. The company will go for a foreseeable future, because we are like investing our money into the company because we believe that the company will go for a foreseeable future. It's not just for like 3-4 years. It's for 10 years, 20 years. The company must have a foreseeable future. Our investment should get a positive return. And that is the background behind it, right? So like in this session, I've talked about like some of the metrics of macro metrics, and a very good question like from my friend, like regarding the terminal value and the present value. So like these things have to be taken into consideration, correct? So like one more request to everyone, try reading my LinkedIn post. Please read my LinkedIn post. A few of the sessions might not be covered in the modules or the live lectures. They might be a part of the future sessions, right? But your interview might be tomorrow or like day after tomorrow. You people can't wait like for my session. So I try to post some complex videos or some complex content on LinkedIn. Read that, read each and every line of that. I've shared the whole link as well, right? The links of different posts. Try reading that and ask me your concerns. Okay. So that is it for today. We'll get back the next week and ask your queries and concerns. Take it on WhatsApp, email, like on like any of the platforms you're comfortable with. And I'm starting a new batch, 41, for like investment banking. If anyone of your friends are interested, so they can join my batch number 41. Okay. So that's it for today. Thank you all. Thank you to all the 150 participants who joined in the Zoom call today. Thank you so much.